There's so much uncertainty in the world right now. Would you like to know about a business model that offers a ton of certainty? Would you like to also collect market-beating passive dividend income? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel. I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is unrivaled at providing high-tech defense products to governments around the world. Sovereign defense is a slam dunk. There is no future world 10 or 20 years from now in which governments are no longer spending money to defend themselves. In fact, the more uncertain the world becomes, the more certain that defense spending becomes, and that benefits this company greatly. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Lockheed Martin Corporation, which appear to be trading at a significant discount today. Lockheed Martin Corporation, stock ticker LMT, is the world's largest defense contractor. Founded in 1912, Lockheed Martin is now a $106 billion by market cap global giant that employs more than 100,000 people. Fiscal year 2019 revenue is broken out by segment. Aeronautics, 40%, rotary and mission systems, 25%, space systems, 18%, missiles and fire control, 17%. The U.S. Department of Defense accounts for approximately 60% of revenue. International sales account for almost 30% of revenue. The remaining 10% comes from various U.S. government agencies. Commercial sales are insignificant. In terms of military weapons manufacturers, Lockheed Martin stands alone at the top. Morningstar declares this, and I quote, "We view Lockheed Martin as the highest quality defense prime contractor given its exposure as the prime contractor on the F-35 program and its missile business," unquote. Lockheed Martin produces an arsenal of major military aircraft, including the F-35 Lightning II, the F-22 Raptor, the F-16 Fighting Falcon, and the SH-60 Seahawk. In addition, the company provides a variety of offensive and defensive weapons, including missiles, missile defense systems, and electronics. The F-35, a fifth-generation combat aircraft, is the largest and most expensive military weapons system in the world. In a world of uncertainty, I can offer you a clear certainty. Global governments will continue to spend lots of money on sovereign defense and security. In fact, this certainty is a counterbalance to the global uncertainty. The more uncertain things get, the more important defense and security become. It's that simple. That bodes well for Lockheed Martin, its profit, and its stream of growing dividends. As it sits, the company has increased its dividend for 18 consecutive years. The impressive 10-year dividend growth rate of 14.4% comes on top of the stock's starting yield of 2.8%. In fact, Lockheed Martin just increased its dividend by over 8% 2 weeks ago. This growth comes on top of a market-beating yield, and with a modest payout ratio of 45.6%, even after that dividend increase, the dividend is very secure. Looking at business growth, Lockheed Martin increased its revenue from $45.803 billion to $59.812 billion between fiscal year 2010 and fiscal year 2019. That's a compound annual growth rate of 3.01%. Meantime, they grew earnings per share from $7.81 to $21.95 over this time frame, which is a compound annual growth rate of 12.17%. Pretty strong. Margin expansion and buybacks combined to help propel excess bottom line growth. The outstanding share count is down by approximately 23% over the last decade. For perspective, looking forward, CFRA believes that Lockheed Martin will compound its earnings per share at an annual rate of 9% over the next 3 years. CFRA specifically points to the company's focus on high priority defense programs that are not correlated to the broader economy or fiscal deficits, unquote, as a key advantage. I concur. Indeed, I think CFRA's near-term earnings per share growth forecast could end up on the conservative side. Lockheed Martin is one of the few businesses out there that is almost bulletproof. Not even this pandemic can stop them. Their second quarter fiscal year 2020 report showed 22% year-over-year earnings per share growth and a $150 billion backlog. Then, only weeks ago, the company raised its dividend by over 8% and added $1.3 billion to their buyback program. This kind of profit growth, along with a modest payout ratio, sets the dividend up to easily grow in the high single-digit range over the foreseeable future. Moving over to the balance sheet, the company has a solid financial position. While the long-term debt-to-equity ratio at 3.65 looks high, that's due to low common equity from the buybacks. The interest coverage ratio of over 12 indicates no issues with its debt costs. I think the balance sheet could improve, however, there are no major problems here. Profitability is fairly robust, and there's been a definitive margin expansion in recent years. Over the last 5 years, the firm has averaged annual net margin of 8.55%. Return on equity, however, is not applicable because of low common equity. Overall, there's so much to like about Lockheed Martin because there's so little to dislike about it. I find almost nothing to fault about the business model or fundamentals, and with global scale, massive barriers to entry, long-term contracts, technological know-how, and high switching costs, there are competitive advantages here. Moreover, there's an oligopoly in this industry. This ensures rational pricing. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. I think competition, thanks to the oligopoly, is a limited problem. On the other hand, regulation is a big risk. There is direct government oversight here. There are unique geopolitical risks in place due to the very business model. A leadership change in the US could result in more democratic control, which might see some near-term pressure on defense spending. Also, production execution has been a recent risk. Cost overruns around the F-35 program can be highlighted. With these risks known, I still think Lockheed Martin is a great long-term investment, but the stock has to be bought at an attractive valuation. With the stock down 13% from its 52-week high, I'd argue the current valuation is attractive. The price-to-earnings ratio is sitting at 16.8. That's quite a bit lower than where the broader market is at. It's also lower than the stock's own 5-year average price-to-earnings ratio of 23.7. There's also a big disconnect on the cash flow multiple. Price to cash flow ratio of 12.8 is well off of its 3-year average of 20. And the yield, as noted earlier, offers market-beating income. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate is at the high end of what I tend to allow for in this kind of analysis. But I think Lockheed Martin deserves the benefit of the doubt. It's arguably the best business in one of the most investable industries out there. The modest payout ratio, product backlog, leadership position, earnings per share growth profile, and proven dividend growth to date all point to this kind of long-term trajectory. The dividend discount model analysis gives me a fair value of $561.60. The reason I use a dividend discount model analysis is because the business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Lockheed Martin as a 4-star stock with a fair value estimate of $433. CFRA rates Lockheed Martin as a 5-star strong buy with a 12-month target price of $504. I came out high, but we all agree that the stock is undervalued and worthy of investment. Averaging the 3 numbers out gives us a final valuation of $499.53, which would indicate the stock is possibly 30% undervalued. Here's the bottom line, guys. Lockheed Martin Corporation is a high-quality leader in one of the most profitable industries in the world, and it's poised to greatly benefit from global uncertainty. With a market-beating yield, almost 20 consecutive years of dividend raises, double-digit dividend growth, a modest payout ratio, and the potential that shares are 30% undervalued, this stock might be one of the very best opportunities in the market for dividend growth investors. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.